It's just got to be considered. And you understand the strategy that you're working with.
Why should I choose an interest-only mortgage loan? It's what we're talking about today on the East Central Business Show. I'm John Naylor and joined by a resident expert mortgage broker, Laura Sillano.
Good morning.
Good morning. Now, we're going to do any advice today?
No, definitely not.
Okay.
Yep.
People should read the disclaimer at the end. Should I go interest-only? I did interest-only back in the day.
Did you?
Loved it.
You loved it?
Yeah, until the time ran out. Oh.
And then it rolled to P&I. Oh, no. And then
anyway.
all hell broke loose.
P&I, come on, using industry jargon there.
Okay,
Let's break it down.
Okay,
Over to you.
There's two, good. There's two primary repayment types when you're looking at getting a loan. One is principal and interest, and that's where you actually pay the loan down from the very first payment. So if your loan term is 30 years and you have a loan of $500,000, after 1 month you will have paid interest and you will also have paid off a percentage of that principal. And that's called amortization. So over the period of the 30 years, at the end of the 30 years, you will have completely paid off the loan.
They show you those lovely graphs, don't they? Saying, oh, there you go. You've paid off this much by 20 years, a little bit more by 25. No, most of it, hopefully. Yeah. So that's principal and interest.
That's a principal and interest loan repayment type. An interest-only loan repayment type is where you're only funding the interest on the loan. So say, for example, it's the same thing again. You've got a $500,000 loan. The interest on that loan is at 4.5%, and at the end of the interest-only period, which is often 5 years in a 30-year term, at the end of that interest-only period, you still owe $500,000.
Familiar, very familiar.
Yeah. And then what happens after that is if you've got a term loan, which is going to kick into P&I at that point, principal and interest payments at that point, then for the remaining 25 years, you will pay principal and interest on that loan, and the repayments from there will go up higher than they would have been should you have paid P&I from day one.
Yeah,
because you've got to pay it off.
It's real.
It's a real thing. Because you've got to pay it off in a shorter period of time, right? So that 5-year interest-only period means that instead of paying off the loan in the 30-year term, you've got to pay it off in a 25-year remaining term. Okay? Yeah.
Yeah.
Does that answer the question?
Yeah, sure does. Well, that's the thing. But I understand what's also important. I mean, in fact, even though I'm a bit sort of awkward about it, like it actually did work for me.
And that's why interest-only payments are still a valid way, I believe, for people to, or it's a valid repayment type for people to select. You need to understand the reasons why you're doing it. So you don't just go into an interest-only period because you can't afford the P&I repayments. That's not a valid reason. If that's your reason, then you probably shouldn't be borrowing the amount that you're borrowing. So the reason why we structure clients to go into an interest-only loan type is often because they have mixed purpose debt. So say, for example, they have an owner-occupied home. They also have an investment property that they've purchased. They are paying off, they still have debt on their owner-occupied home, so they're paying it down. And the investment property is a deduction, which they've discussed with their accountant, against their income or the income that they're using. That they're receiving on it, so the rent that's coming through. They can deduct the interest against it. Yeah. And what that then means is that if they select interest only on that particular purpose, which is the investment property, they then have the ability to redirect the principal portion that they would have paid on the investment property into their home.
Yeah, sure.
And pay that down more quickly.
Yes, it's the non-tax deductible debt.
Yeah. So but that only makes sense if you actually redirect the money into your home. Yeah. It doesn't make sense if you then go
live it on boat in the
Whitsundays
for 5 years. Yeah, how about living on a boat in the Whitsundays for 5 years? It was fabulous. Yeah. Can't remember a thing.
That's a lifestyle choice.
But what's the main takeaway from this? Like, interest only can be a good idea. P&I can be a good idea, is it not?
Yeah. it's just got to be considered. And you understand the strategy that you're working with, and you're happy with that.
Sure.
You know, so the other thing to bear in mind as well is that there is a price differential between principal and interest loans and interest-only loans. So that means that interest-only loans are generally more expensive than principal and interest loans. And because they're more expensive, then you want to consider whether they're appropriate or not for your circumstances.
Sure.
Yeah.
Sure. Sounds like a great reason to have a considered discussion with a good mortgage broker.
Yeah.
How about they ring you, Laura?
Okay.
How do they get hold of you?
You can call me on mobile at 0422 320 497, or you can also email through to the office home@podfinancial.com.au.
Okay, some great information there about interest only versus P&I today on the eCentral Business Show. We'll speak to you next time.